Welcome back to the channel. Today, we're diving into the hottest cryptocurrency trends you need to know in 2025. Whether you're a seasoned investor or just getting started, these trends could shape the future of digital finance. From the rise of decentralized finance to the growing adoption of cryptocurrency by major corporations, we'll break down the key developments that could impact your investment decisions. So grab your notepad, buckle up, and let's jump right into the exciting world of cryptocurrency. First up, let's talk about decentralized finance, or DeFi for short. Now, DeFi is all about taking the middleman out of financial transactions. Think about it. Traditionally, if you want to borrow money, you go to a bank. If you want to send money overseas, you use a service like Western Union. These traditional institutions act as intermediaries, and they charge fees for their services. But what if you could bypass these middlemen altogether? That's the promise of DeFi. By using blockchain technology, DeFi platforms allow users to lend, borrow, and trade directly with each other, without the need for a central authority. This can potentially lead to lower fees, faster transactions, and greater financial inclusion for people who don't have access to traditional banking services. Now, one of the key innovations driving DeFi is the rise of decentralized exchanges, or DEX. Unlike centralized exchanges like Coinbase or Binance, DEX are run on a network of computers, making them more resistant to censorship and single points of failure. This decentralized structure aligns perfectly with the ethos of cryptocurrency, giving users more control over their assets. However, it's important to remember that DeFi is still in its early stages of development. As with any emerging technology, there are risks involved. We've seen cases of hacks, scams, and rug pulls in the DeFi space. It's essential to do your research, understand the risks, and only invest what you can afford to lose. Despite the risks, the potential of DeFi is undeniable. With its ability to democratize finance and empower individuals, DeFi could revolutionize the way we think about money. We're already seeing traditional financial institutions taking notice, with some even starting to explore DeFi applications of their own. Moving on, let's talk about another major trend in the cryptocurrency world: corporate adoption. Over the past few years, we've seen a growing number of major corporations adding Bitcoin to their balance sheets. Tesla, MicroStrategy, and Square are just a few examples of companies that have made significant investments in Bitcoin. So, why are these companies so bullish on Bitcoin? Well, there are a few reasons. First, Bitcoin is often seen as a hedge against inflation. As more and more money is printed, the value of traditional currencies can decline. Bitcoin, on the other hand, has a limited supply, which means it has the potential to hold its value, or even appreciate over time. Second, Bitcoin offers a way for companies to diversify their assets. Traditionally, corporations have held their cash reserves in low-yield assets like government bonds. However, with interest rates at historic lows, companies are looking for alternative investments that can provide higher returns. Bitcoin, with its potential for growth, has emerged as an attractive option. Third, some companies are embracing Bitcoin as a payment method. For example, Tesla briefly accepted Bitcoin as payment for its electric vehicles. While they've since reversed course, citing environmental concerns, the fact that a major company like Tesla was willing to experiment with Bitcoin payments shows that there is growing interest in using cryptocurrency for everyday transactions. However, it's not just Bitcoin that's attracting attention from corporations. We're also seeing growing interest in other cryptocurrencies like Ethereum, which powers a wide range of decentralized applications, and stablecoins, which are pegged to the value of fiat currencies like the US dollar. Chapter 3. Now let's talk about one of the most talked about trends in the crypto world: non-fungible tokens, or NFTs. NFTs have exploded in popularity, with digital art, collectibles, and even tweets selling for millions of dollars. But beyond the hype, what are NFTs, and what's their real-world potential? At their core, NFTs are digital certificates of ownership that are stored on a blockchain. This means that they're unique, verifiable, and cannot be counterfeited. Think of them like digital deeds for digital assets. This has huge implications for a wide range of industries. For example, in the art world, NFTs are being used to verify the authenticity of digital art, giving artists a new way to monetize their work. In the gaming industry, NFTs are being used to create in-game items that players can truly own and trade. And in the music industry, NFTs are being used to give fans a new way to connect with their favorite artists and own a piece of music history. But the potential applications of NFTs go far beyond these examples. NFTs could be used to represent anything of value, from real estate to event tickets to intellectual property. They could be used to create new forms of digital identity and to track the provenance of goods and services. While the NFT space is still in its early stages, the possibilities are truly endless. As with any new technology, there will be challenges and setbacks along the way, but the potential for NFTs to revolutionize a wide range of industries is undeniable. Chapter 4. Now let's step back for a moment and talk about the technology that underpins all of these trends: blockchain. Blockchain is essentially a decentralized digital ledger that records transactions across a network of computers. This makes it incredibly secure and transparent. One of the most exciting advancements in blockchain technology is the development of new consensus mechanisms. A consensus mechanism is essentially the way that a blockchain network agrees on a single version of the truth. Bitcoin uses a consensus mechanism called proof of work, which is very energy intensive. However, newer blockchains are using more energy efficient consensus mechanisms, such as proof of stake and delegated proof of stake. These new mechanisms are not only better for the environment, but they also allow for faster transaction speeds and lower fees. Another major advancement in blockchain technology is the development of Layer 2 scaling solutions. As blockchain networks have grown in popularity, they've faced challenges with scalability. Layer 2 solutions aim to address this issue by moving transactions off of the main blockchain, allowing for faster and cheaper transactions. These advancements in blockchain technology are paving the way for a more scalable, sustainable, and accessible future for cryptocurrency and decentralized applications. As the technology continues to evolve, we can expect to see even more innovative use cases emerge. Chapter 5. Finally, let's talk about the regulatory landscape for cryptocurrency. As cryptocurrency has grown in popularity, regulators around the world have been grappling with how to regulate this new asset class. This has created a lot of uncertainty in the market, which can be both exciting and nerve-wracking for investors. One of the biggest regulatory challenges facing the cryptocurrency industry is the lack of clear guidelines around stablecoins. Stablecoins are cryptocurrencies that are pegged to the value of fiat currencies, such as the US dollar. They've become increasingly popular as a way to hedge against the volatility of other cryptocurrencies. However, regulators are concerned that stablecoins could pose a risk to the stability of the financial system if they were to be adopted on a large scale. As a result, we can expect to see increased scrutiny of stablecoins from regulators in the coming years. Another area where we can expect to see increased regulation is in the area of anti-money laundering and know your customer compliance. Cryptocurrency exchanges have come under fire in the past for facilitating money laundering and other illicit activities. To address these concerns, regulators are likely to require cryptocurrency exchanges to implement stricter AML and KYC procedures. While increased regulation can sometimes be seen as a negative for an industry, it can also be a sign of maturation. Clear regulations can help to create a more stable and secure environment for investors, which can ultimately lead to greater adoption of cryptocurrency. That's it for today's video. If you found this information helpful, don't forget to like, share, and subscribe for more. Let us know in the comments which trend you think will have the biggest impact in 2023. Thanks for watching.